Welcome to the Explainer. If you're an institutional allocator or portfolio manager looking at the current economic dashboard, things look pretty reassuring right now. Almost deceptively reassuring, right? Well, today we're going to decode exactly why that sea of green on your dashboard is actually a massive, dangerous false positive. We're diving straight into the data from the Economic Fragility Index Monitor, issue 19, and let me tell you, there is a giant submerged structural threat lurking just beneath the surface. So let's get right into this iceberg briefing.
Okay, quick look at the agenda. We're going to start by unpacking the structural paradox trap, then hit the top 3 immediate threats, break down the pipeline inflation guarantee, look at real estate collateral deceleration, weigh out some competing macro risk scenarios, and finally, wrap up with the defensive portfolio posture you need to adopt right now. Let's do it.
Section 1. The Structural Paradox Trap. Let's see how those green headline metrics are actively masking some really severe submerged dangers.
So, take a look at this headline number 22.5%. That's the Weighted Fragility Score, or WFS, straight from issue 19. Now that number firmly plants the economy in the green field category, for the 4th issue in a row. Honestly, if you're just glancing at this top-level summary, you'd probably think, hey, it's time to deploy some risk capital. But as we're about to see, that would be an absolutely critical mistake.
And here is why. We are currently trapped in what the report officially calls a structural paradox. The main takeaway here, that 22.5% score is not a sign of systemic health. Far from it. It's actually the mathematically lowest reading possible when a whole bunch of underlying structural indicators are literally flashing red. So how does that happen? Well, high-yield credit spreads are just incredibly compressed right now, and that single metric is acting like a giant weight, arithmetically suppressing the damage from the rest of the economy and artificially dragging that headline score down.
Now, if we pull back the curtain, the underlying data shows us exactly what's hiding beneath that green score. 3 critical structural indicators are just absolutely screaming red. First, commercial and residential property, red, with office vacancies hitting a staggering 18.6%. Then you've got the Fed funds rate, deep in the red at 3.625%. And valuation fragility, also red, with the CAPE ratio sitting at a frankly terrifying 41.0, and the Buffett indicator hovering near an all-time record. Notice the theme? None of these underlying issues have actually improved. They are just being masked.
Which brings us right to the ticking clock. 14 basis points. That is literally exactly how close high-yield credit spreads are to crossing the amber threshold. Right now, the spread is sitting at 2.86%, but the second it crosses 3.0%, the structural paradox resolves instantly. And let's be clear, it's not going to resolve by all those structural problems suddenly getting better. Oh no. It's going to resolve through a rapid, entirely disorderly widening of credit spreads that triggers a full-blown systemic cascade.
All right, moving on to Section 2, 3 immediate portfolio threats. Let's break down the specific acute dangers threatening your stability right this very second.
For the first time in this entire production cycle, the private credit market monitoring protocol has officially upgraded to red. Why is that? Because the shadow credit market is quietly locking its doors before the public markets even catch a whiff of the stress. We're talking about multiple major, non-listed business development companies, BDCs, simultaneously slapping down 5% quarterly redemption caps. Add to that the Fitch U.S. private credit default rate hitting a record 6.0%. Throw in the locked-in pipeline inflation and that razor-thin 14 basis point gap we just talked about, and the immediate threats we're looking at are totally unprecedented. That brings us right into Section 3, the pipeline inflation guarantee. Let's explore why future inflation is practically mathematically baked into the cake at this point, totally regardless of whatever monetary policy does.
So, picture this. Kevin Warsh gets sworn in as Fed chair in May 2026, and he comes in with this big mandate for lower rates, all justified by this massive AI productivity thesis. Sounds great, right? But then, his very first inflation report completely dashes those hopes. April PCE comes in hot at 3.8% year over year. I mean, that is nearly double the Fed's 2% target. Warsh's hands are severely tied right out of the gate, independent of any new inflationary shocks.
And here is exactly why he's trapped. Take a look at the Producer Price Index to Consumer Price Index spread, the PPI-CPI spread. It's sitting at about 220 basis points. That 220 basis point gap, that is what we call pipeline inflation. Meaning this is inflation that has already been manufactured in the production cycle. It's already there. It just hasn't fully transmitted into the consumer basket yet. You can't avoid it, and the Fed definitely can't just legislate it away with a policy tweak. It is locked in, and it is heading straight for the consumer. Next up, Section 4, Real Estate Collateral Deceleration. Let's quickly translate what's going on with these property metrics and what it actually means for your underlying collateral.
Okay, so issue 19 gives us the very first application of the residential property sub-indicator, or RPS. Just to put it simply, this metric tracks whether the real estate that's acting as collateral out there in the market is actually holding its value in the real world. The verdict? It immediately triggered an Amber Alert for the U.S. zone. Why? Because over half of the 20 major metropolitan markets they track just posted year-over-year price declines. Not great.
To put this into perspective for you, the long-run average appreciation for U.S. homes is right around 4.5%, but currently, we're barely scraping by with 0.7% year-over-year growth. And since consumer inflation is running at 3.3% core, that means inflation is actively outpacing home value appreciation by 2.6 percentage points. The bottom line here is that the real inflation-adjusted value of residential collateral is decelerating, and is doing so incredibly fast.
All right, on to Section 5, Competing Macro Risk Scenarios. Let's run the predictive models and weigh the probabilities of exactly how this whole thing could break. So the model gives us two pretty highly destructive primary scenarios. The leading probability, sitting at 62%, is a demand destruction and policy error recession. This is the scenario where the Fed stubbornly holds rates high against an energy shock, consumer demand completely collapses, and that 14 basis point credit spread gap we keep mentioning just explodes. On the flip side, we have a 38% probability of a valuation correction. Remember that terrifying CAPE ratio of 41.0? If equity markets decide to reprice from those near-record extremes, the resulting hit to the wealth effect is going to tighten financial conditions so severely it could practically trigger a recession entirely on its own.
Now, I know what you're thinking. What if we get some good news? Let's say the Strait of Hormuz reopens, oil prices tank, and we miraculously get a geopolitical resolution soft landing in the next 6 to 12 months. Well, the models are warning us that this is a total trap, a temporal superposition, if you will. A soft landing like that is really just a temporary Phase 1 bridge, and it leads directly into an unavoidable Phase 2, fiscal dominant sovereign stress, escalating in about 12 to 18 months. Because here's the reality. Foreign treasury disposal is accelerating rapidly. In just 1 month alone, foreign entities dumped roughly $240 billion in treasuries. So even if geopolitical tensions cool off, the sheer brutal arithmetic of U.S. fiscal dominance and foreign sovereign selling is going to reassert itself and absolutely crush the long end of the yield curve.
Which brings us to our final section, Section 6, Defensive Portfolio Posture Required. Let's tie this whole briefing together into a clear, actionable mandate. The strategic posture directive coming out of the source material is pretty much absolute. It states, no development in Issue 19 warrants relaxing any defensively oriented posture adopted in response to prior issues. Translation, do not let yourselves be fooled by that 22.5% green fragility score. It's a mathematical illusion, purely propped up by compressed credit spreads. When you've got shadow credit gating happening in real time, baked-in pipeline inflation practically guaranteed, and core structural indicators glaring right across the board, maintaining extreme caution is really the only mathematically sound posture you can take.
So, I'm going to leave you with a final, slightly uncomfortable thought to take back to your investment committees today. You have exactly a 14 basis point margin of error before this structural paradox resolves and credit spreads just widen uncontrollably. Is your portfolio truly, honestly braced for that tipping point? Are you out there allocating capital based on a false green light? Thanks so much for joining me for this explainer, guys. Keep your eyes open and stay vigilant.
This video is produced by New Corporate Management Proprietary Limited, NCM, under the Insight Matrix brand. It is provided for educational and informational purposes and does not constitute investment advice, financial product advice, or a recommendation to buy, sell, or hold any security or financial product. The Economic Fragility Index Framework, EFI, is designed to describe systemic constraint conditions using structured methodology applied to publicly available data. Nothing in this video should be construed as a guarantee of future outcomes, a market timing signal, or legal, tax, or accounting advice. All probability estimates are subject to the NCM Epistemic Warrant Audit Confidence Ceiling and are capped at 75% maximum warranted confidence. You must apply independent professional judgment to any strategic or investment decisions informed by this video. All indices used in this video remain the copyright of NCM.